Hey everyone, welcome to another episode of Adam Talks, a podcast that takes an alternative look at retirement. This is Adam Bergman, founder and CEO of IRA Financial. If you want to learn more, you can subscribe to our YouTube channel and follow us on social media. Just search IRA Financial. Hey everybody, and welcome to another episode of Adam Talks. I'm Adam Bergman, tax attorney and founder of IRA Financial. And guess what? If you're private equity, if you're in venture capital, if you got a really big Roth IRA, then the Senate Finance Committee Chairman Ron Wyden, Senator from Oregon, is coming after you. There's a new bill that Senator Ron Wyden and Rhode Island Sheldon Whitehouse have introduced that is, if passed, will kill the carried interest. The carried interest that so many private equity, venture capitalists, and even hedge fund promoters count on to earn their livings will be gone. It will become a stream of ordinary income and no longer will be taxed as capital gains, and even worse, will be deemed income on an annual basis based off a formula that the senators have figured. So I'll get into that in a minute, but a lot of stuff going on. Obviously, I spoke about the Roth IRA cap, which I hope doesn't get passed because just don't think it's going to really help people save for retirement, which is the ultimate goal that Senator Wyden is trying to accomplish. Capping Roth IRAs is not going to help the 100 million or so Americans that are not saving for retirement. It's going to have no impact on them. So this carried interest is going to raise money. Let's get down to it. That's what's going on here. Senator Wyden is not interested in these private equity, venture capitalists, millionaires, billionaires. He's not happy with Peter Thiel and all the other venture capitalists and private equity managers that have been able to turn what he believes is ordinary income into tax advantageous capital gains. So him and Whitehouse's bill will basically close the entire carried interest loophole, including the recharacterization of income from wage-like income to lower taxed investment income and the deferral of tax payments. So he's essentially going to scrap the tax advantage capital gains treatment of a carried interest and basically require you to treat it as ordinary income or self-employment tax-based income on an annual basis. And this is his quote. He says, one of the most indefensible loopholes in the tax code allows wealthy private equity managers to be taxed at a lower rate than nurses treating COVID patients and avoid paying any tax year after year after year. This is an issue of fairness. So not only is Wyden interested of shifting the taxation of a carried interest from capital gains to ordinary income, but he wants you guys to recognize that income on an annual basis, even though the fund is not paid out in that time period, which is basically like phantom income, which goes above and beyond what even President Biden wants to do, which is basically kind of shift the taxation of the carried from capital gains to ordinary income. On top of that, he wants to tax depreciation based off a stream of interest rates. So, and that's really, honestly, the crux of what the progressives are trying to do. Their ultimate goal is to tax appreciation of assets, not just carried interest, but real estate. That's their ultimate goal. Senator Warren has talked about that, whether it's a wealth tax, or however they call it. That's their goal. At the end of the day, they see all this appreciation, they want to tax it because they feel like that is the most equitable way of redistributing wealth. And this bill will hope to raise $63 billion over 10 years, whereas the previous bill, which just talked about converting the carried interest from capital gains treatment to ordinary income treatment, would raise just $15.6 billion. This would raise $63 billion because it includes a formula which will tax this income, carried interest income, on an annual basis. And there's a summary of a bill which I suggest take a look at if you're interested in. But essentially, the way it's going to work is this. Let me give an example. So if the fund manager receives a 20% carried interest in exchange for managing investors' capital of $100 million. And the prescribed interest rate for the tax year is 14%. And they give an example of this prescribed interest rate. Who knows what it will be. The fund manager would pay the top ordinary income tax rate of 40.8% tax on the $2.8 million of deemed compensation. So what they're doing is they're saying, okay, you manage $100 million. There's a prescribed interest rate of 14%. Okay, so what we're going to do, and since it's the 20% carried interest, right? 20% of 100 million at a 1.4% rate, that equals 2.8 million in deemed compensation. Even though you haven't earned anything yet, we're still going to tax it, right? And that's the crazy thing about all this. But a lot of times, carried interest doesn't actually become recognized until there's a capital event, whether there's a sale of company, whether there's investment realization. So what they're trying to do is say, well, we're going to tax it anyways, even if there's no capital event, and you'll figure out whether there's gains or losses down the road, but we're going to get that stream of income. Okay, so that's what they're going after, and it's super aggressive. Obviously, it goes above and beyond what anyone's ever looked at doing in terms of recharacterizing the carried interest from capital gains to ordinary income. So you may be saying, what the hell is a carried interest? Well, basically, it's a form of compensation received by a fund manager in exchange for investment management services. Carried interest entities entitles a fund manager to future profits of a partnership, also known as a profits interest. So under current law, the fund manager is generally not taxed when a profits interest is issued and only pays tax when income is realized by the partnership, often in connection with the sale of an investment that happens years down the road. Not only does this allow fund manager to defer paying tax, but eventually income from the partnership becomes capital gains income tax, which is taxed at a lower tax rate than the ordinary income tax. So what is the bill or this legislation attempting to do? So under this bill, a manager is required to recognize a deemed compensation amount annually, taxed at ordinary rates, not capital gains rate, and subject to self-employment taxes. So essentially, the carried interest is going to become an interest loan. The way they're seeing it is they're saying, hey, if you're getting a carried interest, you're basically getting an interest-free loan from the investors, and we're going to calculate that interest-free loan and charge you interest on that amount and deem it as compensation. So unlike past proposals, this bill avoids long-standing partnership rules by treating all deemed transactions as occurring between partners on the outside of the partnership. So this feature also has the effect of preventing the fund manager from deferring income, acknowledging the value of a carried interest from inception, and decoupling the manager's compensation of income from the fund realization and performance. Again, they are basically creating phantom income. They are going to make these fund managers deem income, even though they haven't had any realization. So you're going to get a bigger issue. How are they going to pay the tax, right? There may not be enough money to pay the tax if their management fees don't cover what this carried potential stream of interest is deemed to be worth. So this is going to cause way more confusion than necessary. There's obviously workarounds. What's going to happen is these funds are just going to say, okay, we're not calling this carried interest. We're going to create a separate class, call it a Class B, and we're going to basically make it a separate economic unit. So instead of it being free, maybe if the LP pays $100,000 a unit, we'll pay $10,000 for a unit, and it pays off only on a super capital event, meaning we will give the limited partners their pref, their return of capital, but if there's a 10% rate of return, these capital or these Class B units will get a percentage of the profit. So they're just going to recategorize the carried interest as a LP interest to get the capital gains. So there's going to be a workaround. This is besides the point whether I believe a carried interest is ordinary income. A lot of tax attorneys believe that, hey, a carried interest is really akin to performance of services. You're getting a profits interest because you're performing services for managing these funds. And hey, let's be honest, this is really ordinary income. The flip side is, hey, these private equity funds are investing lots of money into the economy. They're creating lots of jobs. They are adding value, and this is just the incentive for them to do so. Whatever I believe is irrelevant. The treatment of carried interest or profits interest from a tax standpoint has been capital gains for a long time. Do I think it's right? Honestly, it does look obviously a lot like compensation for services. But the way Senator Wyden is trying to attack it, I think, is wrong. Creating this deemed stream of income that will be taxed or treated as a prescribed interest rate, and then taxing that. I think you're going to have situations where you're going to have phantom income. You're going to be creating all kinds of confusion for no reason. So this is what the private equity industry says. They say their industry has helped over 11 million workers keep their jobs, helped over 13,000 small businesses stay open, fueled sustainable energy projects, and ensured thousands of public servants have secure retirements. Instead of dusting off old proposals that single out certain taxpayers, policymakers should encourage more private investment across America. So they believe that if the taxation of carried interest is changed from capital gains to ordinary income, the private equity industry will feel its impact and maybe will be limited in terms of its investments in small businesses or other businesses, and we're all going to suffer. I'm not sure that's the case. I just think they're going to restructure the way the carried interest is called and just kind of create a second tier of limited partners with this separate economic unit payout, which will kind of reflect and mirror what the carried interest does. It just won't be called carried interest. And then they're going to have to deal with that, the Senate Finance Committee, because they're going to have a separate problem on their hands. So I kind of, listen, this has been bounced around for a while. Even the 2017 Tax Act had some proposals. There's a provision stipulating that certain partnership interests received in connection with the performance of services are subject to a 3-year holding period in order to qualify for long-term capital gains. And that was done through President Trump. So there's been, I won't say bipartisan, but there's definitely been some momentum in terms of changing the taxation of the carried interest from capital gains to ordinary income. So, Senator Wyden is not way off on this. The issue is what he's trying to do by creating this deemed income on an annual basis, and goes back to the whole progressives' goal ultimately is just to tax the appreciation of wealth, right? Whether it's real estate, whether it's capital wealth through equities or business wealth. Their goal ultimately is, as your assets go up, we want to tax it. Even though you're not recognizing those gains, right? It's phantom income. You didn't sell your business, you didn't sell the stocks, you didn't sell your real estate. Irrespective of that, we're going to tax it. Problem, where are you going to get the money to pay the tax if you haven't sold your stock, you haven't sold your real estate, you haven't sold your business? How the hell are you going to pay the tax based off this proposal? Senator Wyden and White House haven't got into that yet. We'll see what they think about it. But this could kill the carried interest. This will ultimately not only put it on life support, but it will destroy it. There'll be workarounds, but the term carried interest will go away forever if this bill is passed, because not only is it going to be treated as ordinary income, but this stream of income will just kill anyone from ever labeling any type of compensation as part of a carried interest, because the tax ramifications will be so detrimental. So again, it's really, really aggressive, really extreme. Again, this example kind of signifies what's going to happen. If the fund manager receives a 20% carried interest, and I'll repeat it, on exchange for managing capital of $100 million, okay, and the prescribed interest rate for the tax year is 14%. I'm not sure how they're going to figure out the prescribed interest rate, but they use this example of 14%. The fund manager would pay the top ordinary income tax rate, let's say 40%, on the $2.8 million deemed compensation. Okay, so basically that's what they say is going to happen. This is on an annual basis. They deem you to earn that, even though you haven't earned anything, even though the fund could lose money next year. I guess they'll have mechanisms for zeroing this out, getting losses as well. If there's no income in a future year, or if there's a scale back or some type of clawback. Again, they're adding complexities to this. But again, what's happening, I talked about also in a previous podcast, there's momentum. There's a push to go after the Peter Thiels, the venture capitalists, the private equities, the hedge funds, the super wealthy, and saying, hey, not only are we going to cap your Roth IRA, we want to increase capital gains. We want to increase ordinary income rate. We want to get rid of the carried interest. We want to deem compensation to you. So they're really trying to hit these, not just the wealthy, but the private equity, venture capital, hedge fund wealthy over the head with a hammer 15, 20 times until they go away. That's the goal. And again, it goes back to their ultimate goal is taxing appreciation of assets. It's always been their goal all along. Senator Warren was pretty clear with her wealth tax. That's what their goal is. Not sure that can get passed, but this is a sideways maneuver to tax appreciation through the carried interest because, hey, who's going to feel bad for a bunch of rich private equity, venture capital, hedge fund guys if they're paying ordinary income on all their wealth? It's an easy target. Not many people will feel bad for them. Not many people are going to really be able to comment on the impact it can have on our economy, but it's an easy target. It's hard to stand up and say, hey, I support these rich venture capitalists or these rich private equity managers. Sorry, I don't think it's right that not only do they pay ordinary income, but they're going to pay tax on deemed compensation. But at the end of the day, there are going to be repercussions. And not only, again, are they changing the taxation from capital gains to ordinary income, but this deemed compensation, again, this mechanism, there's not a lot of, really not a lot of guidance on how that's going to work. But it's going to be phantom income, right? They're going to tax you on income you haven't earned. So if you're carried interest, if you got $1 billion of assets and your carried interest is going to be, 20% of that, and that's, $20 million bucks, and there's a 14% rate, and you're paying, that's $2.8 million of compensation, even though next year, your fund hasn't sold anything, it could lose money, it may not pay out the carry. Doesn't matter. We're going to deem the compensation and make you come up with the tax money. So if your management fees on $100 million bucks or 1%, where the hell are you paying? Where are you getting the money to pay the $2.8 million in deemed compensation? Even though you have a 20% potential carried interest on $100 million, doesn't mean you're going to get it, right? Markets don't always perform. Investments don't always work out. Not every hedge fund, private equity, venture capital fund succeeds each year, right? And some fail. A lot fail. So I just don't see how they're going to pass this. It's going to be a nightmare. But again, Senator Wyden has been just super aggressive by going after not just the rich, but he has a major issue with venture capitalists, private equity, and hedge funds. The Peter Thiels of the world, he does not like. And we'll see what happens. But it will kill the carried interest. It will be destroyed forever if this passes. Again, it was just introduced by Wyden and White House. I suggest if you are in the private equity, hedge fund, venture capital world, you probably want to read a summary of this bill. There's not a lot on there. But again, the Democrats control the House, the Senate, and the presidency. If they want to get things through, they can get it through. They got to pay. Remember, they're passing an infrastructure bill right now, $3.5 trillion. They got to pay for it. Okay, so they're going to look to pay for this. And where's the first easiest way to pay for it? The rich. No one really cares about the uber rich. It's just not really a popular option to go out there and put a flag out and support the Peter Thiels of the world who have $5-10 billion. No one really cares about them. So they're going to go after it. And this bill, they assume, could bring in $63 billion, which isn't $1 trillion, but it's a start. And it's $63 billion over 10 years, which is more than the $15.6 billion over 10 years that just flipping the capital gains to ordinary income would pull in. This deemed compensation adds another good $45 billion over 10 years, which is good for White House and the progressive senators. So they got to pay for this infrastructure bill. And they're going to find a way to do it, whether it's through Roth caps, whether it's carried interest or other ways, increase capital gains tax rate, increase ordinary income tax rate. They're going to be taxing the rich, and this is what we got to deal with. There's really nothing we can do, honestly, with the Democrats controlling the House, Senate, and presidency. If you are not happy with this, other than reaching out to your representatives if they are not Democrats. Without being political, it's just the way it is. Like, they can do whatever they want, and they're going to get it done. This infrastructure bill is important, whether it's bipartisan or not. It's important to the Democrats, and they're going to need to pay for it. And that's how they're going to pay for it, is by taking money away from what they say are the egregious rich, and the carried interest is just an easy way to do it. It's not a lot of money, $63 billion over 10 years, but it's a start, right? It's a start, and it gets them started. So we'll see where this goes. If they just wanted to move this from capital gains to ordinary income, I mean, I think that ultimately we all expect that to happen at some point. I probably wouldn't be doing a podcast about it. It's newsworthy, but I just expect it to happen. But this deemed compensation mechanism is just way out there. And first of all, it's going to be super hard to implement. It's going to be very painful for managers to pay. Will this stop managers from entering into private equity? No, because they're just going to recharacterize their investment. They're just going to put a little bit more money into Class B LP units and not treat it as a pure carry, and just play around with the distribution waterfall and give themselves a larger share of the profits on a super capital event. So just kind of dress up what a carried interest is. There's workarounds. I've been talking about this for 20 years. I've always said, hey, why call it a carried interest? It's just dumb. It's not a it's not a good tax term, because it's really akin to compensation for services. You're getting free money for performing your services well. It looks a lot like ordinary income. Why even playing that game? They're going to switch the rules out on you. Just go back, call it a separate economic investment unit, dress it up, and then treat it as a Class B LP. And if you hit a home run, the fund does well, you get your management fee, and you get the returns on your investment. Don't call it a carry. Dress it up as a Class B, and that's going to be ultimately the way it goes. So, sorry for rambling. It's just one after another. This bill was introduced a couple days ago, and I promised myself I'm not going to talk a lot about the Roth IRA. It's super discouraging. It's got me depressed. I can't sleep at night. So I've talked to some people in our industry, and I said, okay, I'm gonna take a break from going after the Roth IRA cap. But this thing then popped up, and I was like, oh man, Senator Wyden just can't take a break. Whatever happened to summer vacation? I mean, Oregon's beautiful. Go enjoy your time. Stop going after all these venture capital, private equity. I mean, this Peter Thiel. He can't get it. He just can't get enough of this stuff. And he did introduce this bill, actually. Wyden introduced this bill in 19, actually. So he's just bringing it back right now, and adding some bells and whistles with the annual interest on the deemed compensation. So again, I'm just interested to see how they're going to actually implement this. It seems like it's going to take a lot of effort to implement this deemed compensation. And they basically say annual compensation will be determined using the estimated foregone interest on an implicit interest-free loan from investors to the fund manager and a prescribed interest rate, whatever the hell that means. I disagree. When an investor invests in a fund, it's not a deemed interest rate. It's not a loan. They're investing to make money. They're not giving a free loan. It's an equity investment. It's not a loan, right? They're investing in the fund as an equity investment to make money on their returns. The carried interest is a benefit the manager does to do really well. That's the reward for the manager to hit home runs, not a prescribed interest rate on a loan. The LPs, the limited partners, are not lending the managers or the general partner any money. It's an equity investment, and the managers are taking a management fee, which is not what this is about. This is about a carried interest, which is a percentage of the gains. So I think their terminology is wrong. Their mechanisms are wrong. It really doesn't make a lot of sense. But as I mentioned, it goes back to the ultimate goal of the progressives, which is taxing appreciation of wealth. That's how they feel they're going to be able to get all this stuff that they want to get paid for by taxing appreciation of wealth, whether it's real estate, equity, or appreciation on businesses. So there you go. Sorry, it's been a long type podcast, but I just had to get it out there. Also, one last thing. He also, Senator Wyden, again, he's having a busy summer. He also introduced a modernization of Derivatives Tax Act, which is another way of, again, taxing derivatives on an annual basis. Annually paying tax on gains, even though the gains aren't realized. So again, I keep mentioning, but it's true. The ultimate goal of Wyden and the progressives is the appreciation of wealth. So even if you don't recognize the gain on this derivative transaction, even if you don't recognize the gain on the carried interest on the underlying fund, guess what? They're going to tax you anyways. Where are you going to come up with the money to pay the tax? That's another story. I'm not sure they thought about that, but maybe they don't really care. Whether they're trying to kill the private equity, venture capital, hedge fund industry, or just destroy the rich people doing it, I don't know. But again, not every venture capitalist, private equity, or hedge fund investor and promoter is rich. I know a lot of my friends that aren't rich that have failed and have closed funds and started new ones, and some raise a couple million, some raise 10 million, and they're not all billionaires, okay? And a lot of them aren't even millionaires. A lot of them fail and are onto different things, and they are trying to do good. They're trying to invest in small businesses or startups or create value for their investors. And whether you want to tax the carried interest as ordinary income or not, that's beside the point. But this deemed tax on an annual basis as a stream of income, even though it hasn't been recognized, it's extreme. It's not something that's done. You can mark to market assets, but it doesn't mean they're taxable, right? You can require funds to market their assets to get a fair market value for your investors, but you're not paying tax on that mark to market. You're just marking to market. Here, they're going to require you basically to mark to market on a deemed interest rate and pay tax, even though you didn't recognize any of your income. Crazy, but hey, that's the world we live in. So appreciate you guys listening. Sorry for rambling, but just a lot to talk about. Stay safe and talk to everyone again next week. Be well.